Hello and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Ali Dibadj, who is the CEO of Janus Henderson. Ali, nice to see you.
Thanks for having me, Andy.
So most of our audience knows about Janus going back to when it was the go-go growth stock manager based in Denver, merged with Henderson in 2017 before you became CEO. But why did the two firms combine, again, before your time, but I'm sure you know?
Yeah, so the firms came together close to 10 years ago now, so it's been quite some time. And the industrial logic of bringing those two firms together actually made a ton of sense. One firm, Janus, was a little bit more growthy in nature, a little bit more U.S. equities focused, a little bit more intermediary and retail focused. Henderson, a little bit more global, had a little bit more fixed income, more core kind of investing. And so bringing those, and more institutional as well, bringing those two things together made a ton of sense. The thread that tied them is still a thread that we have today as a firm. And it's frankly a thread that we had when the firm started back into 1934, so about 91 years ago, which is that really deep research, understanding companies and using that to invest on behalf of our clients and making sure we create alpha, make sure we create beneficial financial outcomes for our clients. That's the thread that really tied these firms together that we have to this day. In fact, our director of research in the US always talks about knowing the companies we invest in better than the people who work at those companies. That's kind of the mantra, and that was really the glue that stuck these two firms together. And today we are one firm, putting one foot in front of the other and trying to be successful in this asset management world for our clients.
And you're a global company, but you have the Denver and London hubs at this point still, right?
Yeah, so we have those two as our two biggest offices. We have 25 offices around the world, including those two. We're a truly global firm.
And you became CEO, what, in June of 2022? Yeah. What did you set out to do, and how are you feeling about that?
Well, so what we had at Janus Henderson was a fantastic foundation. I mentioned the investment acumen that was very, very strong. And don't just take my word for it. Go look at our performance in terms of beating benchmarks relative to peers. We're right at the top of the list relative to all of our other peers out there. Look at us relative to benchmarks. 2/3 of the time, we beat benchmarks quite handily. So we have this really core foundation of investment acumen, again, that we've been doing for 91 years. And we coupled that with really great client service. We think about our clients and their clients all the time. That's what we do. But what we hadn't done is really think about the growth trajectory of the firm. Think about how we actually match up that investment acumen with the client needs, not just of today, but of the future. And that was what I intended to do. That's what my mandate continues to be with a fantastic team at Janus Henderson. We're almost 2,000-fold, all rowing in the same direction. And that is really around delivering what we call brighter futures to our clients.
And we'll get back to this, but the firm is publicly traded, so you have the equity, and then of course you can invest in one can invest in the funds as well. And do you distribute directly, or is it through wirehouses?
So about 20% of our assets under management is distributed directly to an end client, a person. Roughly 50% is through an intermediary, so a private bank, a wirehouse, an RIA, all those great clients we partner with. And the other 30% is through institutional. So think of as the most sophisticated sovereign wealth funds or pension plans out there come to Janus Henderson to help them manage their assets.
You have this strong legacy in active management, but active management has been hit hard by indexing on the one hand and ETFs on the other. How have you been fighting back?
Well, so a couple things I disaggregate there. I think there's certainly been a very long period of time where active asset management has been under attack, quote unquote, particularly from passive indexing. Mm-hmm. And look, to be fair, when you look back at the time frame where that was successful, that was when there was no cost of capital. Money was free. Look, when money is free and the world is a relatively stable place, I totally get the concept of putting something in an index fund and just waiting for the tide to lift all boats. That makes sense. We're not in that day today, Andy, at all. There is a cost of capital. No matter what fluctuations happen with the Fed, the cost of capital is not going to zero. The world, I'd argue, is not an incredibly stable place right now, geopolitically, demographics, technology with AI. There's so many things changing out there right now. In fact, I'd argue it's the wrong time to put extra money into indexing. In fact, active asset management is the way to go, and that's what 350 people at Janus Henderson do all day long. That's what our heritage is for 91 years, to pick a good company from a bad company. And so actually active asset management is ripe for the times that that are ahead of us today. Now, you mentioned ETFs. Now, I think it's a shorthand for people to think through ETFs as being passive. In fact, they don't have to be. We are actually one of the leaders in active ETFs in equities and in fixed income. In fact, in fixed income, we're the second largest active fixed income ETF provider in the world. We're about 8th in all active ETFs around the world. And that's been a big part of our strategy because our view is, look, if a client wants to ingest something that's blue or green or polka dotted, that's fine. What we're going to do is fill it with our best investment strategies. So we're vehicle agnostic, so to speak. We want to deliver the best investment strategies and the best client service to that client, no matter what the color or the wrapping is of that product. ETF forms, CITs, SMAs, and of course mutual funds, which is still a core part of our business and certainly serves the purposes of many, many clients out there.
All right, so the headline is active is back.
I think active definitely has a place. Everyone can have passive exposure, but active actually, if you can deliver performance, is back.
The SEC recently changed its rules, my understanding is, to allow companies like yourselves to move between mutual funds and traditional funds to ETFs and share classes more easily. How do you feel about that move, and is it enough, Ali?
Yeah, so a couple of things. One is nothing's set in stone yet, so the SEC hasn't yet ruled, but maybe over time it will. But all of us
signaled this, though.
Certainly signaled it. You're right, Andy. Look, we are prepared to deliver, as I was saying before, every investment strategy in the form that our clients wanted. If it's in a mutual fund form, because it's a strategy that needs easier abilities to have access to that mutual fund, an ability to be closed when you reach capacity constraints, that's what a mutual fund is good for. ETF is good for other things. You can trade it every second of the day. You can lever against it, maybe get some tax benefits, et cetera. But again, it depends on the strategy. So we're happy, no matter what strategy, no matter what vehicle is out there, to bring a strategy to bear.
Are you talking about active being back and maybe passive or indexing not being appropriate right now in the markets? On the other hand, the markets look rather frothy right now. What's your take on that? You're an investing professional.
Yeah, I grew up as an investing professional. I work at an investment shop. Look, I think, again, there too, it's very easy to say the market is frothy when we see enormous opportunity across the markets, both equities and fixed income. Take some of the small cap businesses or mid cap businesses in the US equities markets who have not been brought up with the frothiness. You're seeing significant opportunity. Our healthcare teams see enormous opportunity in biotechnology stocks all day long, who've kind of been babies thrown out with the bathwater, so to speak. Same thing in our technology world, not just the big flying AI stocks, but a lot of other AI companies that support AI or the picks and shovels around it. I think it's very blanket to say, again, the market is X or Y or Z. Actually going a layer deeper is what active asset management is all about, and finding those opportunities on behalf of our clients to deliver better financial outcomes with differentiated insights, with disciplined investments. That's what we do.
Janus Henderson has expanded into alternative investments and private investments for retail investors. How do you ensure that those are safe for those customers?
Look, it's a really great point. We need to make sure as an industry that we remember what we are on this planet for. So our purpose statement is the why we exist at Janus Henderson. It's investing in a brighter future together. And this together part is so important. We have to do it for that end client. So just coming up with products because they're privates and putting that into a channel which is for retail doesn't always work. It's got to be in the right vehicle. It's got to be the right time frame for that client. That client has to be educated. The financial advisor has to be educated. It has to fit in the portfolio. There's a lot more complexity around this. It's not just as easy as taking something in private and putting it into that channel. Mm-hmm. That's why we spend so much time on this. That's why we've built a company called Privacore, as an example, that really specializes in taking the right product in the right vehicle, at the right price point, with the right education to the right client. All that has to work together. It's not a simple thing to do. So with Privacore, we're an open architecture platform that selects the best products among alternative businesses out there, not just the big ones, but all the folks who are the best in their asset classes, and we bring that to bear in the right form for that end client.
So that's a business that you built yourself, and you also bought some businesses?
Yeah, correct. So that's a distribution business with specialization in alternatives. And then, yes, you're exactly right. We've been acquiring alternative businesses that fit what Janus Henderson's client base is. We don't just buy it to check the box. We buy it because our clients are asking us for it. And besides Privacore, we've purchased two businesses on the alternative side of things. One is a U.S. asset-backed company called Victory Park Capital, so asset-backed private credit. Very different than direct lending, which we think in the U.S. has kind of reached its peak, let's just say, in terms of what goes into that marketplace. But this is asset-backed, a very different, very well-constructed private credit realm that is just starting to pick up, and that's something that we certainly will bring to our institutional clients. Insurance, for example, we have a great partnership with CNO along those lines, CNO Insurance, but also on the retail side of things. So that is one of them that we brought on board. Victory Park Capital is the best in the business. They've been doing this for a couple decades before asset-backed private credit was cool, right? The other one is non-U.S. direct lending, and our first foray in that is in the Middle East, actually. So we saw an enormous need for private credit in the Middle East, where there's a real vibrancy among small and medium enterprises who just can't get funding from the large sovereign wealth funds because their check sizes are too small, and can't get funding from banks because loan to deposit ratios are 105%. So there's a real opportunity there, and that's what we're focused on. So those two areas for now, but there'll be more from us later.
I read that your latest assets under management is $457 billion. That may be slightly out of date, but that was the latest regulatory filing.
Yeah.
You've seen a lot of inflows, my understanding is, but is that because of these acquisitions, or is this organic inflows?
So no, it is organic inflows. You're exactly right. Good research, almost $500 billion of assets under management, and that's been growing for us. We are one of the very few companies in the quote-unquote traditional asset management space that is actually growing organically. And that's because we're meeting clients' needs. We're asking clients what they need. Some of it is these acquisitions, some of it is active equities, active fixed income, kind of the traditional stuff that we have, but a lot of it is new products that we're developing for and with our clients. So you mentioned ETFs, our active fixed income ETF suites. Now we have 5 active ETFs that are over $1 billion, and they continue to grow because they're meeting the need of our client base. Our global small cap product on the equity side of things, we had a really fantastic and still have a very fantastic U.S. small cap business, great in the UK, great in Europe, great in Japan and Asia. We never brought that together. There's a real need, particularly as a response to private equity, not returning capital to our clients, who wanted global small cap public equity. So we delivered that to them. That's been growing like a rocket ship as well. Biotechnology hedge funds have been growing quite well, and we have a great experience level there. It's all of those things, but it's also some of the quote-unquote historical businesses that we've had. Our balanced fund is growing tremendously outside the U.S. So balanced takes the benefit of fixed income when there actually is a yield, with the benefit of having a cost of capital out there and being able to be active equity pickers and putting that together in a balanced fund. Many more things. It's not just inorganic.
You're in a fairly unique position of being a British-American firm. How does that inform your thinking in terms of doing business, and how are things in the UK right now?
Yeah, great question. We are indeed a global firm, and I think being rooted in 1934 in the UK and in 1969 in the US, where we're now one, really allows us to have a global view on things. We serve the most sophisticated sovereign wealth funds, the most sophisticated pensions, the most sophisticated family offices, the most sophisticated investors around the world. And this global purview, this global kind of perch that we have really allows us to have different level conversations with our clients. From a UK perspective, look, it's a tough market, I'd argue, in the UK right now. I think there's still a lot of uncertainty there, but it's all relative. We see some green shoots happening in the UK. We are a big believer in the UK, and we think that there's growth there. But again, we are a global firm.
I noticed that your stock has matched the S&P since you became CEO, but it has outpaced T. Rowe Price, Invesco, Franklin Templeton. Is it too late to buy the stock, though? Has the stock already run up too much?
Well, look, I'm a big believer in the future of Janus Henderson. I'll leave it to others to think about their portfolios and whether they own the stock or not. I'm a big believer in the stock, but again, just because the team here is fundamentally doing a fantastic job. We're growing the business, we're meeting clients' needs. We think there's a lot of potential for the company.
And how do you think about the stock in terms of its PE and also the ratio between the market cap of the company and the assets under management?
Well, so for us, it's less about the assets under management versus the market cap, in fact. Not all AUM is created equally. We very much look at, yes, growing the AUM, but it's all about, from a shareholder perspective, growing revenue and growing EBITDA. But you can't do that, and people forget sometimes, you can't do that without meeting your clients' needs. We think about this as the clients that we serve. So again, the sovereign wealth funds and pension plans, et cetera, that we talked about before. But really, really importantly, and this is key, Andy, for us in our culture, that end client as well. We serve 60 million people around the world, directly or indirectly. They rely on us for their retirements, on us for their savings, on us for improving their lives. We think about that and we try to deliver for them together. That's kind of what this ampersand, by the way, stands for. It's together with those end clients. That's how we think about it. That's a real measure for us. The stock will come.
If you're a global business though, Ali, I mean, how do you cope with different regulations in different markets, and is that difficult to handle?
It's become much more difficult for sure. The complexity out there and the sometimes countervailing trends that are going on around the world are things that we have to operate with. But that's what we can do as a global firm. Again, $500 billion of assets under management, 2,000 people around the world. That's what we do, is we're able to deal with those complexities from a regulatory perspective on behalf of our clients. But again, think about what we do at our core. We're investors. We also use that global opportunity to share information and invest globally on behalf of our clients.
Is there anything you'd like to see out of Washington, D.C. in terms of regulation, though, Ali, that would help your business, you think, make for a better marketplace?
Well, look, I think we're headed in the right direction, broadly speaking, which is we were clamped down, all of us in the industry, quite a bit. It feels like things are releasing somewhat. That's at least the feeling that we get. And certainly that direction is the right direction for us, who's a firm that, first and foremost, will think about our end clients and do the right thing.
And an adjacent question, do trade wars affect your company and your business?
Not directly, but what we are seeing is if you are investing in small and mid-cap companies or real estate that we offer or technology or healthcare, you have to think about a lot of things. So for example, you have to think about supply chains. And again, as active asset managers, we choose what regions of the world will benefit and which ones will be detracted from trade wars. So we benefit from that. We are a very global firm, and one of the other outcomes of trade wars, not just supply chains, is that people's allocations are changing. I mean, think about it. 10 years ago, allocation to the U.S. was roughly 50%. More recently, 65% of people's global allocations were in the U.S. You're seeing that dissipate a little bit. Now, it's going lower. I don't know if it gets to 50%. Guess who benefits from that? Janus Henderson certainly does, because we are so global in equities, in fixed income, in alternatives. We offer different opportunities for people who want to take their allocations to a lower number when it is inside the U.S.
And final question, Ali, tell us a little bit about your story. I know you went to Harvard College and Harvard Law School. Where did you grow up, and how did your career path lead you to the seat that you're currently in?
So I grew up in Montreal. So I'm Canadian, came to America for college, stayed here, as you mentioned. I was very fortunate enough to have great mentors along the way in different parts of my career, whether it be in management consulting, then as an analyst in an investment firm, then a portfolio manager, and then I was pulled into working in the corporate side of things as strategy and CFO, and then came over to Janus Henderson. And really, I didn't plan on this outcome, to be very frank and honest, but I was very lucky to have mentors and guides throughout my career who kind of guided me in the right direction. And thankfully, I'm working at a fantastic firm with great values and delivering for our shareholders and all of our stakeholders.
Ali Dibadj, CEO of Janus Henderson, thank you so much for joining us.
Thanks, Andy.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.